Hello and welcome to Morningstar. I'm Jocelyn Joven, and today I'm joined by Talib Sheikh, who's the co-manager of the JPMorgan Global Income Fund. Talib, hello.
Hi there.
So when you own a diversified portfolio with bond and equities, what's the best protection in a rising environment with rising yield and inflation?
I really do think as we look into 2017 that diversification across all portfolios is going to be incredibly important. And really that's one of the benefits of a multi-asset portfolio. Clearly we have parts of the portfolio which can benefit from a rising interest rate environment, particularly the equities, the cyclical assets which we hold within a portfolio. But clearly when we have a primary focus on yield, inevitably there'll be bond type assets. And the place where we have a reasonable allocation at the moment is into US high yield. It gives us a pretty attractive yield. Yes, there's a credit spread and the credit spread can compress even as treasury rates start to move up. So certainly when we look at our forward-looking expectations, we think growth is positive, not likely to accelerate too far. And globally interest rates maybe go up a bit, but certainly the idea that we're in a huge interest rate hiking cycle is something which we would disagree with.
Okay. Since the beginning of the year, the emerging markets have been rebounding and continue to rebound despite the volatility of the Trump election. Do you see value there, and do you see opportunities both in equities and emerging debt?
Yeah, we've been pretty light really on emerging markets, both the fixed income, the debt, and also the equities. For the last 3 or 4 years, as you say, they've re-rated emerging market equities over the last few months. It isn't something that we particularly embrace, and I think it's worth looking at emerging market equities with a yield focus. They really don't have the same cheapness as emerging market equities which you're buying for growth, so we've been quite light across those asset classes. The other thing that I think is important is there's lots of debate about what does Donald Trump mean when he talks about WTO and a pulling back from global trade cycles. We can have a debate about how onerous that's likely to be, but I think the mass globalization which we've seen over the last 20 years maybe is not over, but it's certainly on pause, and certainly from our point of view that means that emerging markets are not particularly preferred from a yield focus. We think they're better places where you can find that yield for a more attractive risk return objective.
Okay. And what would be those places? Maybe developed markets, the US, for instance?
Yeah, certainly. Developed markets is something which we've had a preference for. Developed market equities is something that we've had a preference for. And actually we've got some reasonably significant allocations across the European region. So if I look at the equities that we hold in the fund, just under 40%, nearly half of those are actually in the European region, including the UK. And really that's because we can build a portfolio of diversified assets which have a yield of above 4.5%. And at the end of the day, I think the interest rate environment in Europe is likely to stay incredibly low for a long period. So a basket of diversified equities which yield over 4.5%, the dividends that are distributing in a zero interest rate environment, I think is pretty attractive, and certainly that's a significant allocation to the portfolio.
Speaking of Europe, the political agenda will be pretty heavy this year and probably create some volatility. How do you manage this kind of events in your portfolio?
I mean, clearly volatility in Europe is something, political volatility is something which we have to get used to. I think we're probably a bit more sanguine than the consensus. There are lots of checks and balances across the European political system which perhaps mean the winner-takes-all environment which we saw with Brexit or even with the election of Donald Trump probably unlikely to be seen, but clearly that's something that can't be dismissed as zero. So watching how that's developing very, very closely. But certainly when we look at the European political backdrop, we would argue that that political noise offers attractive entry opportunities. GDP in Europe just north of 1%, that's probably about as good as it gets. Credit growth maybe accelerating to some degree. That's all a really nice backdrop for buying those European equity assets, particularly because you're just looking to harness that dividend yield rather than some amount of explosive growth.
Okay. Talib, thank you very much.
Perfect, thank you.
Thank you. For Morningstar, I'm Jocelyn Joven. Thanks for watching.